Given the weather situations going around the nation, we're looking at what are the impacts of weather-related sales, and there's a special provision in the tax code that addresses this. So what's the application? Well, of those rules, it's livestock sold due to any weather-related condition. And the rules or the definitions of that is flood, drought. Then they jump in and say any condition causing a shortage of water and or feed. So what it does is it allows a taxpayer to postpone income recognition from the sale proceeds by what happens when we have a weather-related sale. A lot of times we move the sale of the animals into a time span where they would not normally have been sold. So you end up with bunching of income in years when you would probably have more sales than normal. And then the following year, you'll have less sales. So it allows us to kind of level things out. So what we're looking at here is a way or the presentation to help you understand and be able to discuss the rules and provisions of the weather-related sales with your tax advisor prior to your tax filing, so that you can take advantage and limit the adverse tax situation that can and often does arise. So when we get to drought information, there's several sources of this drought and disaster information that is available. There's the top two, the FEMA have presidential declarations, and then you've got the Farm Service Agency, which is probably the most common for the drought rules. And then we have the Drought Monitor, which is state and national drought intensity maps. It looks at on a state and then breaks it down per county, et cetera. So those are the three things we look at when we try to begin the process of determining the severity of drought and whether or not or what rules do apply. So if you look at the Secretary of Ag designations, this was brought up to date last week, May the 12th. And if you look at the last month's information of April declarations or designations, it's growing and growing rapidly, getting much more red and a much broader area. Then we have the Drought Monitor Map. The Drought Monitor breaks it up into a little more detail, looking at anywhere from no drought to exceptional drought. And the darker the area, the worse the drought is. And this information is brought up to date every week. So between the two, we have the information that we need to apply those various tax provisions. Now, there's two different tax treatments. When we're looking at sales in excess of normal, or in not our normal or usual business practice due to a weather-related condition, we have two sets or two options. The first applies to sales of any type of livestock. And I put the code section from the Internal Revenue Code there, so that when you go to your tax preparer, you take this information, he can look that up and apply the rules and get the information that needs to be added to the tax return to make that election for the 451 rules. And we'll explain more what that is. The second one, 1033, is the involuntary conversion. So involuntary conversion is treated differently, and it applies only to draft, breeding, and dairy animals, not poultry. So draft, dairy, breeding, and the involuntary conversion means we're going to buy them back. That's our plan, is to replace those animals we sold. Whereas the prior one looks at deferring the income for 1 year, so that we move the income from the year that the animals were sold, that would not be normal, to the year that we would have normally sold those. Again, references there. Take those to your tax advisor. He can help you look through them. So what happens? We have two types of ordinary income, or income rather. Ordinary income, that's the sale of calves. And when we're looking at selling breeding livestock, it's a recapture of depreciation taken on those purchased animals, purchased breeding animals. We could also have capital gain income. If we have raised breeding animals, the cost of raising those deducted as the animals are being raised, so that when we end up getting rid of those, their basis is zero. It's all capital gain income. it gets a much more favorable tax rate. Currently, it starts out as possibly as low as 0, goes up to a maximum of about 20%. The normal tax rate's 15 to about 34, 35, depending upon all the things that apply to you. So capital gain income, great, applies to the 100% on raised breeding animals. Now, if we sell purchased livestock, breeding livestock, for more than what we paid for them, that difference between what we paid and what we're sold for is then capital gain income. But remember, we have some depreciation recapture on the bottom end that's ordinary income. So that's the types of income that we're dealing with when it comes to the sales of these animals due to the drought, due to the weather condition that are in excess of normal. So we're going to break them down and look at them one at a time. So here's the deferral of income. The first one we talked about, where we move the income from the year of actual sale to the year that they would have normally been sold. What has to happen? Drought, flood, other condition has to be severe enough that we get the area designated as eligible for federal disaster assistance. That area being your county that you live in, or a contiguous county to that area. If that applies, then we can apply the rules. Any animals sold in excess of normal, move to the following year. All we have to do is show that the weather-related condition caused the sale of more animals than would have normally or usually happened. Another rule that has to apply is the farmer uses the cash method of accounting. That's the majority of our farmers. Very few use the accrual method. So they're required to use the cash method if they're going to use this deferral of income. Again, it applies to any livestock, all including those draft, breeding, and dairy animals. They just have to be sold due to weather-related conditions. Sale proceeds, that income on those animals sold in excess of normal can be deferred to the next taxable year, but there are certain requirements that have to be met, and those are: our principal business must be farming. That's fairly simple. All we have to do is have more than half of our income in prior years be from the business of farming. So even though we sell them in a situation where it's not our best interest to sell them, for example, due to that drought, sometimes we have depressed prices in an area because a lot of animals are moving. You're looking at a prior year when normal business practices would apply. Again, have to use the cash method of accounting, show that the animals would have normally been sold in the following year had the drought not occurred. That's fairly simple. All you're looking at is what your inventory of numbers and what your sales numbers for the prior 3 years were. And then anything above that average would be the excess of normal. And then we have to prove that the weather-related condition that caused the area to be declared eligible for assistance caused the sale. Again, that's your county, a contiguous county, and you have animals in that area that would then result in those sales. Now, there's a bit of a piece of here that does help. Since the livestock do not have to be raised or sold in the declared disaster area, only thing has to happen is that weather-related condition that caused it to be declared eligible for assistance must have caused me to sell those animals early. So how does this work? Let's say you've got property that may be in the county that's definitely affected, and you've got some property that's outside of that, but the area that the calves are that's outside of the disaster declaration, they're older, they're more mature, they're ready to go to market, plenty of grass. So you sell those due to sound business practices, and then you move the animals in the weather or the drought conditioned area out to the better pasture. You're selling more animals than normal. You're moving the animals in the declaration area. All you've got to remember is I wouldn't have sold those animals early if I hadn't had a weather problem throughout my business. So consequently, you've got some room to work. Also, it can be before the area is declared eligible for assistance or even after. So if you see the drought coming, you need to move the animals. We later get that declaration, that's fine. we made a decision. We got the ability to move that income to the next year, even though we sold them before the declaration occurred. And again, you're looking at your history. Taxpayers' history determines what those numbers of animals that would have been sold normally, and then the number of animals that were sold due to the weather-related condition. Now, what happens is the sale proceeds, it gets deferred. It's not reported in income in the year that it actually occurred. You defer the income to the following year, which would be any normal business practice. So here's an example. We normally sell 20 head of cows annually. So our history is every year we sell 20 head, but due to the drought condition, we're going to get rid of 30. So we're going to get rid of 10 additional cows. We're going to elect to defer that income for 1 year for those 10 additional head. We attach a statement to the tax return showing that we normally sell 20 head annually. We show information concerning the weather conditions that cause the sale, that being the county or contiguous county numbers, basically that map that the Secretary of Ag provides us, showing that we got a declaration. Therefore, we elect to move the income from those 10 cows from 2021 until 2022. That simple. Now, the next provision. So that was deferral of income for 1 year, applies to all animals. The involuntary conversion means that we're going to plan to repurchase those animals or buy back replacement animals within the prescribed period. So the involuntary conversion essentially is we not necessarily postponing the income for 1 year, but we're going to avoid the recognition of that until we sell the animals that we buy to replace the animals we sold. So for sales in 2021, we have to replace the livestock by the end of 2023. Again, doesn't apply to poultry, doesn't apply to calves, only to draft, breeding, or dairy livestock. And that replacement period can be extended. It can be extended from 2 years to 4 years if we get a declaration from the federal government or an agency as a federal disaster area. So this is one of those that we don't have to have the Secretary of Ag declarations. That was this one. All we have to have is the Drought Monitor Maps indicating that the area that we're in is suffering from severe, extreme, or exceptional drought. So again, the livestock, they can be held for any length of time. We could have replacement heifers that we're looking at putting into the herd. They could be yearlings, not yet bred, but due to the drought, we had to sell them. They qualify for this involuntary conversion treatment. They could be old animals, doesn't matter. So held for any length of time. So that relevance is that they have to be for draft, dairy, or breeding. Length of ownership does not apply. We bought a replacement heifer to go into the herd, and we've later found out we couldn't keep her. If we only had her 2 months, well, the purpose for buying her was to come into the breeding herd. It qualifies. Now, the gain realized, that gain can be postponed. What we have to do is saying we're going to use the sale proceeds to purchase replacement livestock. Our goal is to replace them within that 2-year time span. If drought gets bad enough, we'll have 4 years. All we have to do is make sure that we get it done, show records that we did replace them, and the animals that we buy have to be for the same purpose as what was sold. Dairy for dairy, breeding for breeding. So if we've got beef animals, we have to come back with beef animals. Milk cows for milk cows. Now, one of the neat things about this provision is that we don't have to buy back dollar for dollar, or head for head. So if we sell 10 head, we don't have to buy back 10. We sell 10 head for $20,000, we have to buy back $20,000 of replacements. So it's dollar for dollar, not head for head. And what you've got to look at is, again, that exceptional, extreme, or severe drought. Those are the 3 worst conditions from the Drought Monitor Maps. If those are met, then we have the That extends that period of time. We get to 4 years. The IRS posts every September a notice that lists every county by state in the US that qualifies for this deferral treatment. So when you looking at this, you have this situation, your tax preparer has the ability to search for that, irs.gov, and you can find out these notices of the extension of the replacement period. Now, again, the applicable region, it's the county that experienced a drought plus any contiguous county to that specific county. So your applicable region is not necessarily just the county that was involved, but anything that touches it. Like I said, the 2-year replacement period, drought area doesn't receive federal disaster declaration, goes to 4 years. If it does receive a federal disaster declaration from the Secretary of Ag, and then if that drought continues further beyond the 4-year or beyond 3 years. So we got a consistent drought, 3 years goes by, we're still in the drought. The Secretary of the Treasury further extends on a year-to-year basis that replacement period. Give you an example. There's a couple counties in Oklahoma that are in their 11th year of drought under the extreme, exceptional, severe. And we've kicked that can down the road. We've now got another year to buy those animals back. Now, there's no requirement that the weather-related condition caused the area to be declared eligible for federal assistance for those involuntary conversion rules. All you have to have is a drought monitor. So there's a lot of confusion saying, well, we have to have a federal disaster declaration. No, you don't. But you only get the 2-year replacement if you don't have a federal disaster declaration. All you have to do is show the weather-related condition caused the sale of more animals than normal. Now, one of the things that also we failed to mention here is that when you receive the proceeds from the sale, you can use those proceeds to buy feed, haul water, etc., pay the cost of hauling water, etc. You just have to remember that when you get ready to buy those animals back, you have to have the financing to do so. So you can use the funds for anything you need to, but you want to make sure of when you get ready to buy them back that you do have the funding or ability to borrow the money to acquire those replacement animals. Now, here's what it takes to make the election. You're attaching a statement to the tax return. You're showing evidence of that weather-related condition. Those 2 maps, that's the easiest. Also, you could apply or attach the IRS notice. That works as well. You have to make a computation of the amount of gain realized. Basically, you're looking at what's your basis in the animals. We'll talk about that in a moment, what basis is. Compare that to the sale price. That is what your gain realized that you're postponing. That's the amount of dollars that on a per head basis, so you multiply that by the number of those animals sold, and then you have the amounts that you're going to need to buy back. So again, you need the number of kind of livestock sold and how many would have normally been sold under normal or usual business practice. So here's another example. Here we have the situation, normally sells 30 head of cull cows annually. Drought conditions that occurred 2021, sells 45, so 15 more than normal. Those 15 heads sold for $50,000. So we elect to defer the recognition of that income. Again, that's that statement, show that we're going to be replacing those. When we get ready to start buying those animals back, we have to buy $50,000 of replacement heifers or cows within that required time span, at 2 years or possibly longer. If we spend exactly $50,000, or then we have nothing we need to do. If you look at the first bullet, it says, if he spends less than 50 for the replacements, we're going to have to go back and amend the 2021 tax return, pay the additional tax that would have been owed, plus some interest. If we spend more than the 50,000 for the replacements, we have now invested a greater amount. We depreciate that additional dollars on our tax return because we just spread that excess over the 50,000 among the number of cows we bought. That's a depreciable basis in those. So again, no harm, no foul. You spend less, we've got a problem, we're gonna have to amend the return. Spend more, you have additional expenses to deduct as depreciation. So again, if you're in a severe situation, 4 years to replace the animals, replace as many dollars as sold to avoid problem with the recognition of gain. Repurchase, it can be staggered in the period. So I'm looking here at a 4-year replacement period. You don't have to buy them all back in year 4. If you have a chance to buy some back in year 2, 3, and 4, all you have to do is keep track of the dollars spent annually and the tax basis that would apply to those animals that we bought in those years. Not difficult to do. So the information again needed for those cows: gross income, the remaining tax basis in the cows at the date of the sale. Well, what is that? Raised cow basis is typically 0. So our cost of raising basically is deducted. So her basis is 0. Basis of a purchase cow is her cost less any depreciation taken. And then we allocate that tax basis from the old cows to the new. Now here's what tax basis is. I told you we'd talk a little bit about it. Tax basis is essentially what the animal or what the item is valued on your books. So if you're looking at buying an animal or buying an asset, your basis is the purchase price plus any acquisition costs. If you inherit property, your basis is the fair market value at the date of the death of the decedent. So when you inherited the property, if you receive it as a gift, your basis is the same basis as what the donor had when he gave it to you. So if you receive some Walmart stock and the owner or purchaser originally paid $100 for each share and you get that today, your basis at $100, it doesn't matter what the value of it is. And then any adjustments to the basis, this primarily applies to purchase property. It's our depreciation taken and or improvements made to that property. Those are the adjustments to the basis when we buy it. So that's how you get basis. That's the tax basis information. That's why a raised cow has 0 because we deduct the cost. That's why a purchase cow, you're looking at her purchase price less any accumulated depreciation, that being her tax basis. So when we buy them back, we're looking at the tax basis for the new cows. So total cost of the new cows, it's adjusted for the sale value of the cows sold in excess of normal. So the tax basis of the old applies then to the new. We have to then allocate that on the total number of new cows purchased. The reason for this is we don't have to buy back head for head, it's dollar for dollar. So you have to apply the basis of what was sold. In our example, we had 15 head. If we buy back 10, we have to make the allocations of those 15 on the number that we buy back, or that 10 head. So it's a little complicated, but basically it's just a matter of making the application, getting all the numbers in, working with your tax preparer, showing what you bought. They make the calculations. It's fairly simple, fairly straightforward.
So JC, when you're working with your tax accountant and going through these drought times, you're going to want to stay in contact with them kind of regularly so they can assist you and say, hey, we may have to amend that one, kind of give you a heads up, or is that what you're recommending here? Or are you just going in every year and kind of prepping and seeing where the status is at that point?
Great question. Here's what I've seen over the history of working in extension. Normally what you see is the fact that the farmer makes the decision in the year that we sell those animals, and we pretty well keep track of what's going on, but we work with the same preparer over that 4-year span. The preparers usually ask the questions. But what sometimes happens is you have a taxpayer that changes tax preparers, hires a new accountant. A lot of times we lose that information in the process. Ideally, as a farmer, you want to keep track of the information as well as keeping your preparer appraised of what's going on on a fairly regular basis, not just at tax preparation time. But that often doesn't happen. Ideally, it should. So great question. You need to keep your preparer informed. They can help you make decisions. It can save you a lot of dollars in the long run. Thank you.
Good. Thanks.
So you have the ability to pick between the options. Like I said, the first one, the 451, where you defer the income for the next year, applies to all livestock. 1033E rules, that's the decision to buy them back. It only applies to draft dairy breeding. So you have the two options to pick through. It's not an easy answer which one to take. Your economic situation, your tax situation, what your goals are, all have an impact. The other side of the coin is you can make a change if you make the 451 election to defer the income for 1 year. You can then change your mind easily and go with a decision to not buy or postpone the income, but we're going to buy back those animals. However, if you make the decision to buy them back and then you later want to report the income, it's not as easy. Can't do the reverse. Some things to consider when you want to look at this. What's your personal goals? Business goals. Are we going to be scaling back due to the drought? We're old enough that we want to scale back. Has the drought impacted our operation enough that we're probably not looking at buying back as many animals? Are we looking at changing our business plan so that we're no longer strictly cattle, but we're going to get into some other activities? There's all kinds of things there that you need to look for. Are you looking at retiring or moving off and getting somebody else on the farm? All of those items can impact and will impact your decision of which of those two provisions you want to take. The current and future income expense items that you're expecting also play an impact. Tax rate changes. If you're expecting a change in the tax laws and rates are going to go up, you may want to report the income early because you'll pay less tax in the long term. There's some things to think about. When it comes to which method to select, the information on realtax.org, weather-related sales, gives you a good idea of what's taking place. You can read through there. There's some more examples, a little more detail. Take that information to your tax preparer. Look at the consequences of both the 1033E rules, the 451G rules, involuntary conversion versus deferral of income. Look at those, evaluate them. It can help you make the decision. One thing to remember, everybody's situation will be different. So work with your tax preparer to kind of get an idea of what is best and most beneficial for you. Some other items to look at: farm versus non-farm income, your tax brackets, whether or not income averaging can work for you. So you sold more animals than normal. You have low income years prior to that. You might want to move it back, get a refund. Disaster payment proceeds. There's a bunch of those coming in or expect for the future. That applies. Crop insurance, etc. Net operating losses that have been carried forward can also impact your decision of what to do. So with that, if there's questions, let's talk about that before we get into the disaster losses. That's primarily looking at what are the rules and things we need to think about, fires, other casualties that can occur.
So JC, you mentioned that there were some counties in Oklahoma that had just kept kicking it down the road for 10 years. What about if in that period you decide that you don't want to buy the cattle back, you're just done? What happens if you're a few years down the road you decide that you don't want to buy them back?
There's two situations that I've run into. One was we got 6 years down the road, like you're saying. Farmer decided he'd had enough. He was not going to buy those animals back. We ended up having to go back to that year that we made the election to defer that in, or to not report the income, but we're going to buy them back. We had to amend that tax return. So we went back that 6 years back, amended the tax return on that one.
Did that change the interest and penalties?
Yeah, you had to go ahead and pay the penalties. Okay. But again, he decided to want it out. So was the consequences of that decision. Okay. Another scenario is, and we run into this, particularly in that area that's been so long. When the farmer actually, the rancher actually passed away. And we had to address the issue because we had that law or made the decision, we had to go back and fix that return as well. So there's some long-term implications here, and you got to kind of watch them. Most of the time, what I see happening is that disaster been going on, and I've got some folks that have been buying back a few head at a time. And we just applied the rules to buying some of those animals back and adjusted over that period. So there's all kinds of ways around this. We just need to be aware of those, what you need to do. For example, normally you raise your own replacements. If you take into that deferral or you're going to buy them back, you may want to buy back some replacement heifers in that period of time, even though you normally raise all of yours, just so we can clean up the tax laws or the problem. So again, there's ways of working through this so that we don't have a tax problem later on.
Well, and this is why you want to have those conversations with the tax preparer, and be kind of aware of what's going on as you're going through there. So
Exactly. Thank you. Let's get into the last part of this. There's just a few more slides left. What we're talking about here is we've seen fires in the California area, and we know that this drought, every time we get into these, start to experience this and the severity that we're noticing in the Western states, we're going to have problems with fires. No matter how you slice it, it will occur. So what are we looking at in terms of the casualty rules? So casualty losses, those are sudden, unexpected, or unusual events, not a gradual deterioration. Theft, fire, vehicle equipment accidents, fire if it's not willfully set, flood, tornado, earthquake, you can read through those, but basically you have to look at a sudden, unexpected, or unusual event in order for it to get the casualty loss treatment. Now, there's been some major changes that have taken place. So what we're looking at here is what you need to have in your files so that when this occurs, we can take advantage of the casualty loss rules. How we determine the extent of the loss, we're looking at the property immediately before and after the casualty. So good condition before, burn up afterwards. How bad was it? So you're looking at then the loss in the value. So business use property, we've got raised production, raised hay, things like this, treated differently than purchased assets. If it's a tractor, combine, you've got the purchase price less the depreciation. So you're on your books. There's certain items there that have a depreciable tax basis or new tax basis. You'll have other purchase assets, not depreciable. Then you've got cost shares and the tax treatment there for when you replace or rebuild. Good example here is fences. So your fence is burned down, you get cost sharing from FSA to replace or rebuild the fence. Those cost sharing expenses can result in reducing the loss or even possibly income from a casualty situation. Call that a casualty income. Personal use property is different from business use property. And depending upon whether items are insured or not, you end up with the possibility of a gain on that particular item versus a loss, or when you start netting everything together, you could have gains and losses. So when you start looking at this thing, what we're trying to do is before the fire occurs or before the disaster occurs, be sure to have information available. Let's talk about some of the tax rules that do apply. So if it's business use property, remember what we said about basis in the prior discussion. You're looking at the remaining tax basis. If it's positive, above zero, you have some potential for a deductible loss. For example, combine that burns up. If the basis of that combine was $10,000, you hadn't depreciated completely. Now you have the fire, it completely destroys it. You have a $10,000 casualty loss on that combine. If that machine was insured, you received the payment for $100,000 of insurance proceeds, you'll need to buy back that combine, use the insurance proceeds to do so. If we buy back more than $100,000, then we don't have casualty gain. So casualty gains, you'll want to elect to replace the asset. If it's a casualty loss, you'll have a deduction on the tax return, depending upon the size and some other information that does apply. Now, personal use property, like business property, you're going to have to look at each and every item. You're going to look to see if it's insured or not. Now, with personal property, so you're talking the home, you're talking about items in the home. Sometimes we'll have the home insured, but we may not have all the contents insured. So we're looking at all the contents in an area, in a situation where, let's say, the contents are not insured, what all the losses were there. You're looking at all the items that burned up. You have $100 that reduces that amount of itemized deduction that's allowed. And then you further reduce that by 10% of the adjusted gross income for the taxpayer. So there's a lot of provisions here that you've got to look at. If it was insured property on personal use, insurance proceeds, personal use property not included in income, but it can offset the amount of the casualty loss that's deductible.
JC, I had a question for you on business use property. Say your barn burns up and you have all your saddles and chaps and spurs and bits and everything in there. Some of them may be higher dollar bits than the other ones, and saddles, those vary widely. The documentation is fairly strict on that as far as being able to get, because there's a wide difference between quality of saddles and tack and stuff.
Exactly. What I hope you've got is maybe your purchase receipts when you bought those. If not, you can rebuild that information by looking at what those differences in values to replace them. Not ideal. And then you got to look at some wear and tear on those, so you're going to reduce it some, but that's how you're going to have to rebuild your records if you don't have a good one.
Okay.
In a moment, I'll show you how to get some of that information to rebuild records where you may not have them for either business assets, business items, and non-business items.
Great. It goes back to records.
Exactly. So here's what we talked about on yours. If you're looking at the Reconstruction of Records, it's very detailed. This IRS publication 2194, it's a disaster resource guide. In that guide, it talks about how to reconstruct records, how to reconstruct what you've lost, how to get historical information, where you can go to get historical information for various assets and items. So, for example, tractors, you may be able to look at, well, the value of a 20-year-old tractor. You go to Machinery Pete, for example. It gives you places to where to begin to find out what a 20-year-old tractor that might be in my condition, not perfect records, but it'll get you close. It's better than doing nothing. Another thing that's helpful, photographs. Photograph after the loss. Hopefully you've got something beforehand. Another thing you need photographs for, loss of livestock. FSA provisions say you've got to be able to prove that livestock were killed. If they burned up, take pictures. Show them how many were injured. All of those pieces. Inventories of feed, grain, etc. that's on the farm. Your tax records are another great place of information. So not all inclusive here, but that IRS publication points you to a lot of places to get you started. And another thing that we put together is that there's a item on rural tax, disaster losses related tax rules. They're in that material, and I happen to be the writer of this, put together 12 examples of different property or assets, some insured, some not, some reconstructed, some where we got cost sharing, personal items, business items. So I tried my best to get all the categories included. Then we can talk about how to reconstruct your records, how to rebuild it. Because if your home's gone, a lot of times that burns up all your information as well. And then there's a whole list of helpful IRS publications and resources. I think there's about 10 or 11 of those in that publication that points you to different directions of where to get help, what information is out there, how to get an idea of what you need to put together so that when you go talk to your tax advisor, you can begin to construct the information and to get an idea of what the deductible losses would be. One thing you want to do, very important, just like with weather-related sales, as soon as it occurs, go talk to your advisor, a tax accountant, your tax advisor. Tell him what happened. Have him help you start putting together the information. Because if it burns now, here we are in May, by the time we get to March or April of next year, a lot of water's gone under the bridge. We can forget what did happen, what was lost, miss a lot of items. So with that, kind of wraps things up. My contact information, have questions, feel free to email me.